So the thing is, let's take this as an example. You purchase a Range Rover for $100,000, right? You have to put a down payment on it, right? You're not going to purchase it all in cash because we know cash in the bank probably sits better than putting money into depreciating assets such as the car. So let's say you put that 20% down on a $100,000 vehicle. That's $20,000 out the door for you. So what's going to happen now if you use that vehicle for business? Let's say somehow you're going to keep that ratio of business use to personal use to above 50%. You know what? For the math's sake, let's just use 100% business use. Very tough to make a case for it, but let's say that you do have 100% business use of that vehicle. At that point, you take 100% of that vehicle for business use. Then you have the bonus depreciation, which allows 100% of the purchase price, not the price of what you finance the vehicle for or the down payment, but the full price of the vehicle. So what that means, you're now going to have 100% of 100,000. Then that's going to deduct from your business profit, right? So let's say that you have a $300,000 net profit in the business without you having that car. At 30% tax bracket, let's say, that's going to be a $90,000 tax liability. Introduce the Range Rover now into that business. Remember, 100% business use, and now you have 100% bonus depreciation. So what happens is that $300,000 net profit gets further deducted by the $100,000 from the vehicle, landing you at $200,000 net profit. Let's say that somehow your tax bracket got lowered to 25% instead of 30, 25%, and you have the $200,000 profit, you have a $50,000 tax liability. So your tax liability just decreased from $90,000 in the first example to now $50,000. So you save yourself $40,000. It sounds great, right? Because the $20,000 that you put down as a down payment comes back and you get the $20,000 tax savings. However, you have to keep in mind, using a car for 100% business use, especially if that's your only vehicle, is going to be a tough nut to crack with the IRS. And on top of that, you have to think that a Range Rover is going to cost you a lot in repair bills as well. So it's not as easy as trading a dollar for another dollar. Always make an informed decision and don't put your money into a depreciating asset. Rather, maybe put your money into real estate or something that is appreciating while still taking advantage of tax saving strategies. For more tax advice, go ahead and follow us, Clever Taxes Elite.